Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good day, all. Ira Epstein of Linn & Associates with your metals market update, and this is for Monday, the 14th of August, 2017. You know, one of the things last week we were talking about is how do you play for this weekend's events, or Monday, today, in the metals. And the reason I say that is things could have either died down between the U.S. and North Korea or picked up. This is the week where supposedly North Korea's military is going to give the plan to Kim Jong-un if he wants to send the missiles at Guam. And very important, tomorrow is the holiday where North and South Korea both celebrate Japan leaving the Korean peninsula, obviously during the wars. And when that has taken place, okay, offers an opportunity for both presidents to offer speeches to their constituents. Well, is tomorrow going to be the day that Kim Jong-un just heats everything up again? Is it a day where he sends a missile over Japan to just show them we're independent? I don't know. And I'm certainly just throwing everything on the table. The stock market thinks not. Metals are down a bit, but not the silver that much compared to gold. The dollar's up. You take it upon yourself to give the guess. What we've done here is the question is, can we break out to the upside, or is this market going to fail and go back to the 18-week moving average of closes at 1256.50? I don't have the answer for you. I can start putting parts of the answer together in a way here. As we take a look at an area chart of closes, you've certainly gone from 1262.60 to 1294 and given up about $7 now. Actually, today's close, so you will know, is 1290.40. That's where the settlement will be. So it's $3.40 higher than where the market is right now. Remember, they determined the settlement at 1:30 Eastern, 12:30 Central Time. As we take a look at the chart, instead of having a big reversal, it's just backing off. Very gradual, but it is a back off, not unexpected if you didn't have an event over the weekend. Are we trending? Not by the definition of what makes up an uptrend. In an uptrend, you have higher highs, higher lows, just the way you were doing it right here. Do you see that? Here you've got a pattern of a higher high and a lower low. So this break could easily set up the pattern of higher lows, but then you have to get over that 1298.10 to prove you're able to go to the uptrend. You're in a resistance area. The market has settled the fact that if we come back in time here, the 18-day average was under the 100. It gets over it. Now can the market go up and make a higher high? And it certainly did all that. So it resolved itself that way. The longer-term average, the 100-day and the 18, they're crossed over in a way that's bullish. Whenever the short-term average is over the long-term, that's a friendly crossover, and that's exactly what you have there. The market has hit a brick wall at the upper Bollinger Band. That's the lower band. Now, what's the theory of Bollinger Bands? The market will trade within those bands 95% of the time, plus they offer an objective on uptrends, an objective on downtrends. They don't have to be hit, but when they're hit, it's very smart to pay attention to an algorithm that has 95% of the time it's going to do something. When we take a look at the slow stochastics, this is a market that is not embedded. If we take a look, both numbers are over 80 today. Fine. Both numbers were over that number on Friday, but not there the day before. So if we're down tomorrow, you're not going to embed. If the market's down and closes up, you might embed. Depends how deep the market breaks for this math, the formula of it, to work itself out. I can't answer what it's going to do, but I know how the formula works. Right now, if the market's down tomorrow, it does not favor embedding. When we come to the ETF of GLD, the big gold ETF, you have the same pattern of a lower low, a higher high. You had a bullish crossover that made new highs. It ran into the upper Bollinger Band, same problem. If we take a look at how many days today Both numbers are over 80. They were both over 80 on Friday, and they were not on Thursday. Identical setup. The GDX ETF, the mining stocks, you have the lower low, the higher high, you hit the upper Bollinger Band. So the theme is that the upper Bollinger Band did its job. It offered plenty of resistance, and the market is now backing off. In the gold-silver ratio, this is basically how many ounces of silver do you need to get an ounce of gold? That's what I look at. It tells me which market's in favor. Right now, silver is in favor because you're falling from 77.40 down to 75.10. So you need 2.3 ounces less of silver to buy it. In other words, instead of having 77.40 ounces, imagine that in a shopping cart, you need 75 ounces right now. Think of how many pounds that is. When looking at the momentum of the market, you're in overbought territory. Where's price? Against all kinds of resistance. The upper Bollinger Band, the 100-day average. Plenty of resistance here. What I'm not showing on this chart, I just don't want to show the line, is the 200-day average is right where this high is. So the market is fighting also for longer term, what's it going to do? My guess is if North Korea starts something, the market jumps all that. If they don't, the market backs off. That's the theory. There's another theory with silver. Economies around the world are getting better. Silver is used in so many products. Forget about North Korea. Maybe this is a market that wants to do better on its own. Let's take a look at this chart. This is copper. I've got it. I knew I did everything wrong today. I was having one of those days. This is not silver. This is copper. And copper's got a double bottom here, still to an upside. What do you see wrong on the chart other than my screwing up the name? You lost your embedded reading. When you lose the embedded reading, get out of Dodge if you're bullish. Price often retreats to the 18-day average. Now, that may not mean much to you. It means a heck of a lot to me, because to get there, you might lose the uptrend, and you certainly have lost, past tense already, the upward momentum. Now, to get it back, you'd have to be up sharp tomorrow in this copper. In the platinum market, you've got a pattern of higher lows, higher highs. You are knocking on the door of losing this embedded reading. A common theme, losing it in copper, platinum, gold may not embed. So you either get something tomorrow with North Korea, or these metal markets act like they want to pull back. A market that is still strong is the palladium market, because it, in fact, has the numbers that are embedded today, yesterday, day before. So you got your embedded reading. This is stronger than all the other metals I've just shown you. The dollar index has rallied back to and fighting a battle at the 18-day average as it's searching for direction. It doesn't have it yet. You've got a higher high, a lower low, momentum trying to go up and running into the brick wall of that 18-day average as it tries to figure out what to do. So I put it all together, and I use another feature that I have here called the chart of the day. Now, what the chart of the day is, think of it as Fibonacci numbers with swing lines on steroids, a formula like that. That's the way I describe it. We don't share the formula with anybody. We teach you how to use all this. It's all in our charting software. And the formula, I will share something. The formula is fascinating because it gives you 5 different objectives. You rarely get to the 5th one. The first one's a high probability of hitting. After that, it fades a bit to the second. The third, even further fade. Getting to the 4th is rare. It happens. The 5th, so infrequent that you have to have it because we've seen it happen, but it's infrequent. Now, what's the idea here? If a market starts up, how often have you said to yourself, how high could it go? And what charts do with this price count, it gives you a zone. And that's what you're looking at, a zone for where the market might go if the counts are met. That's the whole purpose of it. What do you do when you get the first count and you haven't hit it yet and you got that high probability? That's something we've been asking. One of my brokers here is now starting to put together option ideas on how to play that. You can ask any of our brokers if you can get onto his letter. You might want to do that. But to get this, and it's a free service, and I'm talking the chart of the day. Either go to our website, www.iraepstein.com. You can click up here at any point. If you're watching me on YouTube, form will appear. Underneath us, you just click. It says click here for Ira's free info. Away you go. And of course, you're always free to call us, and we'll take care of it right away. I'm Ira. You have a good day, and I'll see you tomorrow.